Hey, welcome back. It's Jason Walter here, and here's your latest housing market update. I'm laughing because that took me 10 times to say that. Any case, in today's housing market update, I'm going to take a deep dive into some early indicators that's really telling us that our housing market is really slowing down. One of those is looking at mortgage applications, because one would assume if fewer people are submitting loan applications in order to buy houses, that would imply that home buying demand is decreasing, right? So let's go ahead and dive right into the video here. And if you guys get any value out of today's video whatsoever, then please hit the like button. I really appreciate that. Also, if you appreciate these frequent housing market updates and you haven't subscribed just yet, then I invite you to do so. So with that said, let's go ahead and dive right into the video here. And this is according to the Mortgage Bankers Association, or the MBA. They actually posted yesterday this report here, and they say that mortgage applications decreased by 6.3% from 1 week earlier. And by the way, this is approximately a 20-year low for mortgage applications right now. And this is for the week ending July 15th of this year. So let's go ahead and dive right in. So as you guys may know, mortgage applications represent purchases as well as refis. So overall, which includes refis plus purchases, that decreased by 6.3% from 1 week ago. Well, let's have a look at refis versus purchases. I'm more focused on purchases, obviously, because refis are tied directly to mortgage rates. And because mortgage rates have increased about, or almost 3 percentage points in the span of a year, refis have basically been falling off a map. So the refi index actually decreased 4% from the previous week and was 80% lower than the same week 1 year ago. No big surprises there. Refis have basically fallen off the map. In contrast, though, the seasonally adjusted purchase index actually decreased 7% from 1 week ago, but the unadjusted purchase index increased 16% compared to the previous week and was down 19% from the same week 1 year ago. So in this weekly survey that the MBA conducts, they only show weekly trends as well as how it compares to 1 year ago. So instead, let's have a look at this, because this is a graphic depiction showing their purchase index over time. And here's the last year. The index right now is at 208. The higher the number, that means basically that more people are submitting loan applications to buy houses. And the lower the number obviously means just the opposite. So right now it's 208, the lowest reading in the past 12 months. But let's have a look over the past 10 years. So over the past 10 years, here's the trend line for the purchase index. Again, the lower the index obviously means that fewer people are submitting loan applications for home purchases. So over the past 10 years, here's the trend line. So the current reading at 208 is the lowest reading since November of 2016 if we exclude the COVID lockdown period back in April 2020. So in other words, the amount of mortgage purchase applications at its lowest levels in about 6 years. And according to Joel Kahn, who's one of the MBA's vice presidents, he stated the following: total mortgage applications declined for the third consecutive week, reaching the lowest levels since 2000. Again, that includes refis plus purchases. And he says here, because mortgage rates have increased more than 2 percentage points compared to 1 year ago, their refi index fell to a 22-year low. Now, of course, applications for purchases decreased as well, and this is due to a weakening economic outlook, high inflation, and persistent affordability challenges that are impacting buyer demand. And this decline in recent purchase applications aligns with slower home building activity due to reduced buyer traffic and ongoing building material shortages and higher costs. This is exactly what I've been reporting to you guys over the past several months, because builders are more focused on building apartment buildings to rent out rather than building single-family houses. Meanwhile, the share of people submitting loan applications for adjustable rate mortgages, or ARMs, actually decreased to 9.5% of total applications. The significance regarding this is that we reached a peak of around 12%. I believe that was about a month or two ago, where we had the share of activity for ARMs was about 12%. But back in January of this year, the share was about 3%. So basically right now, the share of applications that are ARMs are about 3 times the share compared to January 1st of this year. And the reasoning for this is the difference between the mortgage rate for a conventional loan compared to a 5/1 ARM, for example. So for the week ending July 15th of this year, the average 30-year fixed rate mortgage was at 5.82%. But for a 5/1 ARM, that basically means that the interest rate, or the mortgage rate, is fixed for 5 years. Then it becomes adjustable every year after that. That's a 5/1 ARM. That decreased to 4.6%. Therefore, if someone's looking to buy a house right now, they're more enticed to get a 5/1 ARM, for example, because the rate is approximately 1.2% lower than a typical 30-year fixed rate mortgage. Obviously, there's some risk involved in getting an ARM versus a 30-year fixed rate mortgage. So for a 30-year fix, at least your rate is fixed for 30 years. But for a 5/1 ARM, for example, your rate is only fixed for 5 years, then it becomes variable and adjusts to current market conditions or current rates after that short period of time. I mean, back in 2008, this was a very popular loan product. I believe the share of people using ARMs back in 2008, 2006 to 2008 was approximately 50 to 85%. We're also seeing this decrease for mortgage applications for brand new houses as well. So also according to the Mortgage Bankers Association, they actually just posted this a couple days ago. June purchase mortgage applications for new houses actually decreased 12%. Again, these are mortgage applications in order to buy new houses that decreased 12% in June. And that's compared to 1 year ago. But compared to May 2022, applications decreased by 10%. I really think there's not a big surprise that we're seeing a decrease in mortgage applications, given the fact that we have affordability challenges and of course of rising home prices and of course rising mortgage rates. But I actually want to give you guys a concrete example regarding this because obviously home buyers are really facing a lot of headwinds right now. So let's have a look at a typical monthly mortgage payment 1 year ago compared to now for a brand new house. So 1 year ago, the median sold price, according to the U.S. Census Bureau, this was back in June 2021, was basically $375,000. If we were assuming putting down a 20% down payment, that would give you a loan amount of $300,000. Also assuming a 2.98% mortgage rate, that was the approximate average 30-year fixed 12 months ago. So assuming no taxes, no insurance, no HOA dues, your payment, which would be principal and interest only, would be $1,260 per month. But fast forward to now, the median sold price for a brand new home right now, at least as of May, we don't have June's numbers just yet, but that would be $449,000. That's an increase from $375,000 1 year ago. Also right now, the average 30-year fix is 5.7% for people with exceptional credit. Obviously, a big difference compared to the 3% from 1 year ago. So if you were to buy an average price brand new house right now, your new housing payment would be $2,084 per month. The difference between that compared to 12 months ago is $824 per month just on principal and interest only payments. And obviously, if you were to take into account property tax increases, obviously this difference would be even greater than $824 per month. I just want to share that example with you guys because a difference of $824 per month is a giant increase when the original payment was only $1,200 or basically $1,300 per month. So that's one reason why we're seeing a big pullback in home buying demand, regardless if it's an existing house or a brand new home. The MBA also provided an estimate of new single-family home sales for June. June home sales will be released by the U.S. Census Bureau in about a week or two, and I'll definitely make a video regarding that. But the MBA actually provided an estimate about new home sales for June. So they were estimated that new single-family home sales are going to be running at a seasonally adjusted annualized rate of 620,000 units in June 2022. And this is based on their builder application survey here, again, decreasing by 10% compared to May 2022. So they're forecasting that the U.S. Census Bureau is going to be announcing a June home sale numbers in about 2 weeks from now, that the seasonally adjusted annualized rate is going to be 620,000. And this is a big decrease compared to May 2022. May 2022, that rate was 696,000 units. Therefore, the MBA is predicting that home sales are going to be decreasing from 696,000 down to 620,000 units. According to Joel Kahn of the MBA, higher mortgage rates and heightened economic uncertainty cooled borrower demand in June, leading to new home purchase applications declining to its lowest levels since April 2020. And this is why the MBA is estimating that for June, new home sales are going to be decreasing yet again. They actually are forecasting for a 15% drop from May. And by the way, if you're curious what people are using in order to buy brand new houses right now, based on this June survey here, by product type here, conventional loans compose 73.7% of all loan applications for new houses. FHA loans made up 15% of those applications. USDA loans composed of 0.5%, and VA loans made up 10.7%. And the average loan size of brand new houses actually decreased from about $431,000 in May to about $427,000 in June. And to summarize today's video, we're seeing a big pullback in home buying demand right now. Obviously, one of those indicators we're seeing right now, which is a very early indicator of home buying demand, is a pullback in mortgage application numbers. So mortgage applications decreased 19% from the same week 1 year ago. And also we're seeing a big pullback in applications for brand new houses as well, decreasing 12% compared to 1 year ago, but more importantly, down 10% compared to May 2022. And the pullback we're seeing right now for mortgage applications, in my personal opinion, is due mainly to housing affordability or lack thereof. If you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day. Look forward to seeing you on the next video.